Section 2 of Topic 4, Paper 8 takes us on to margin financing. Now, margin financing is where an investor will borrow money, usually from a broker, and will then invest in listed securities, only putting up a fraction of the cost, him or herself. Now, a very high chance of at least one question on margin financing in the Paper 8 exam. Now, I'll take you to the second bullet point on page 13. The acquisition of securities can be a fraction of the cost, but profits or losses are realized on the full value of the securities. What is happening is that the investor is gearing up, is taking on leverage, so that if the securities go up in value, then the return of the investor is going to be more. It's just like taking on a mortgage in a property. The property market goes up. The investor enjoys the total increase in the value, not just that related to their equity. Okay, let's look at an example, and a question in the exam could easily be a number question. So in the box, Ivor investors to buy 40,000 shares of Gear Up Co. at $100 per share, and his broker is willing to offer an 80% margin on the company's shares. It's actually an 80% loan, but that's the terminology they use. If Ivan takes the full margin financing, calculate the following, assuming no interest expense nor other charges. And that qualification often is given in the question. You assume no interest, no other charges. And you're asked to calculate minimum amount that Ivan has to pay to buy the shares, maximum amount of funds Ivan can borrow, Ivan's return on investment if Ivan sells shares at $120 per share, and fourthly, the return on investment if he sells them at $88 per share. Now, from the information given, you can see the answer to the first two very quickly. If it's $100 a share, broker is willing to give 80% financing. That means the broker is paying $80 towards each share, and Ivan is paying $20. Okay, let's look at the answers. The minimum payment, well, just as I said, Ivan pays 20% of the $100, $20 per share, but he's looking to buy 40,000 shares. So the minimum payment for Ivan is 800,000 Hong Kong dollars. Maximum borrowing, well, it's 80% of the share value, $100 a share, 80%. The margin financier Gear Up Co. is going to provide $80 per share, 40,000 shares. So the financier will contribute 3.2 million. So 3.2 million plus the 800,000, that covers the total cost of 4 million. Now, the third question was, what's Ivan's return if the share goes to $120? Well, share goes to $120. The original cost is $100. So $20 is made for each share. There are 40,000 shares. And we divide that by the amount of money, not that was invested in total, but that was put in by Ivan, which is 800,000. And if we calculate that, we find that the return is 100%. Now we can see that if the share price has gone from 100 to 120, the market return on that share is 20%. But because of the leverage element, Ivan achieves a return on investment of 100%. That is the gearing effect. What about the fourth question, the return on investment when the share price goes to $88? Well, if it goes to $88, overall, the return is minus 12%. It's gone down 12 from 100. That's a 12% loss. But when we multiply that by 40,000 divided by the 800,000 invested by Ivan, we find that the loss incurred by Ivan is 60%, minus 60% return, as opposed to an overall 12% loss. So you can see the magnification of both the positive return and the negative return. Be prepared to do such a calculation in the exam. Moving on. Benefits and risks of margin financing. Well, two benefits listed: the leverage effect, that is the magnification of the return that I've just illustrated, and enhancing market liquidity, because people are borrowing money to buy shares, which is enhancing market liquidity. Top of page 14 alerts us to the risks of margin financing. Well, we start off just as we did with the benefits, the leverage effect. So not only are returns magnified, positive returns, so are losses magnified. Second risk is margin calls, because if you go into a margin position and the share starts to fall, then the broker can call in margin. That is, the broker wants the incremental losses to be covered by the investor. Obviously, that's a risk. And then pooling risk. This is where a broker can repledge the client securities. So Ivan bought the shares, and then often Ivan would pledge the securities to the financier as collateral. If Ivan gives the financier the authority to repledge the securities, the broker can repledge to a bank and borrow money to cover the position. The risk is that if the lender calls on the broker, if the broker gets into trouble, then the repledged securities could be liquidated, and Ivan, the investor, would lose all their money. So that is a third risk, and they're referred to that as pooling risk. Okay, we move on to the third section in topic 4, covering types of securities. Here we're looking at stock, borrowing, and lending. Now this covers situation where a broker, an exchange participant, can borrow stock from one client and lend to another client. The client who borrows the stock often is doing it so that they can enter into a covered short sale. Because if you don't borrow the stock with a short sale position and you are not covered, you've breached the Securities and Futures Ordinance, because that would be deemed to be naked short selling. 3 bullet points. You could get a question covering those points, and it would be one question on margin financing. So you can see some areas it's a lot more efficient in terms of studying to cover the questions. Section 4 on unit trusts and mutual funds. Well, these are forms of collective investment schemes where contributors put money in and the money is professionally managed. Now, the second bullet point tells us that a unit trust managed funds, the trustee holding assets on behalf of and for the benefit of the beneficiaries, whereas a mutual fund will be a company structure established as a company. Now, we have a table there, bottom of page 14, highlighting the differences between unit trusts and mutual funds over the areas listed down on the left. Be aware of those differences. Easy to write a question testing you on the distinctions. We then look at the benefits of, top page 15, benefits of investing in a unit trust, a mutual fund, or a collective investment scheme. Well, this is sort of general knowledge in the investment world. Professional management, low custody costs, access to global investment opportunities. You're able to diversify by the fact that the unit trust, the mutual fund itself will diversify, and there can be tax advantages. Disadvantages of investing in such investments, trusts and funds: long-term investment vehicles, so it's not the sort of thing that you flip quickly. Lack of investor control, you have no control at all. The only control you have is selecting the trust or fund, and the ongoing management fees that you have to pay. Section 5 considers pilot program securities. This is a pilot program introduced in 2000. The notes are there. I'm not going to dwell on it. I've never seen a question covering the pilot program. Section 6, exchange traded funds. These are collective investment schemes, but they are specific funds that track an index. They're designed to track the performance of a benchmark index. Major exchange traded fund ETF in Hong Kong is the Tracker Fund, which came out of the government intervention in the markets in 1998. The exchange traded funds are traded on the stock exchange is the same way as shares. And please remember that exchange traded funds pay dividends, just as ordinary shares do. Easy to examine that point, and has been examined. Supply and demand for these funds can sometimes result in the market price being different from the fund's net asset value. That's the same with any listed fund. And the last point under section 6, most exchange traded funds are passively managed. That is, that they are benchmarked to an index, and if they move away from the index, then they will adjust the weighting of the individual investments. But we're told that the stock exchange in Hong Kong started to list active exchange traded funds, and these attempt to outperform market indices. Now, we look under 6.1 at leveraged and inverse products. This is fairly peripheral, I would say. Be aware of what leveraged products are, inverse products, and the notes at the top of page 16. I'm not going to dwell on that. Again, as I say, fairly peripheral. REITs, on the other hand, section 7, pretty core material. These are funds that invest in income-generating real estate properties, not shares in property companies, but the real estate itself. And the classics are listed there: car parks, shopping malls, offices, service departments. Now, the majority, indeed in Hong Kong, it's over 90% of income should be distributed by way of dividends. And the REITs, real estate investment trusts, are bought and sold on exchanges. Now, section 8 on depository receipts. This is a developing field. And again, if it was examined, it'd be one question. Let's just look at the overall definition and then the different elements to them. These depository receipts, they're certificates issued by a depository bank representing foreign shares held by the bank. So usually an investment bank buys a large chunk of a foreign company. They then issue certificates on those shares and they list the certificates. These are the depository receipts. These receipts carry the same risk as the underlying foreign share. Okay, let's look at the different types. We have American depository receipts, which are the most common. ADRs, issued to investors in the US, can be traded without delivery of the underlying stock. In fact, they won't be. That's the point of them. And they are, as it says, they're virtually equivalent to holding the underlying stocks. Global depository receipts are issued to investors in more than one country. The ADRs are in the US. The global depository receipts, more than one country, but they're denominated in US dollars. European depository receipts have been introduced recently. They are denominated, not surprisingly, in euros. And then towards the end of 2009, we were introduced to Hong Kong depository receipts. Now, the Hong Kong depository receipts are similar to the others. They provide Hong Kong investors the opportunity to invest in overseas stocks, providing diversification benefits. Now, the Hong Kong depository receipts are traded, settled, and pay dividends in Hong Kong dollars. The depository, the bank, takes care of currency conversion, delivery of corporate information, etc. So it's a fair bit of detail, but generally I would be aware of the different types of depository receipts and what they reflect, the fact that they are listed and they act like the shares, but the shares are actually held by the institution, the depository, that is issuing the depository receipts.